The saying goes that you can never quite tell when you're in the midst of a speculative bubble until it's too late. It's almost like the nature of these collapses to catch everyone by surprise. This pattern has repeated itself throughout economic history. Take the financial crisis of 2008 for instance. Very few choices were sounding the alarm when it came to the housing market. At that time, the prevailing belief was that we were not in a bubble at all. Instead, there was a widespread perception that we had reached a new permanent high plateau. The argument was that valuations were now fairly priced because they were part of some kind of new paradigm. The truth is, identifying speculative bubble in real time is a challenging task, and predictions often vary widely. It is a complex interplay of market dynamics, investor psychology, and economic factors. So while we may not have a crystal ball to predict precisely when or if a bubble will burst, staying informed and vigilant about market conditions is crucial for making sound financial decisions. In recent times, there has been a rush to address some rather extraordinary developments in the housing market. For quite a number of years now, it has been evident that housing prices have been soaring to astonishing heights, not just in one country, but on a global scale. This phenomenon is by no means confined to the United States. It is a widespread issue that has taken root across the world. To put it in perspective, let's take a closer look at some eye-opening examples. In the post-2008 era, England, for instance, has witnessed a remarkable doubling of real estate prices since the lows of 2009. Similarly, if we cast our gaze towards New Zealand, we can find an analogous trend where prices have doubled since 2009. Meanwhile, in various parts of Europe, such as Germany, we observe a strikingly similar pattern. Even here in the United States, the trend is apparent. It's as if the entire world is experiencing a surge in housing prices that defies conventional expectations. The question on everyone's mind is, what could be driving these extraordinary price increases, and what implications might they hold for the future? Housing price doubling isn't just by chance. It is because governments worldwide decided to keep interest rates super low for a long time after the 2008 recession. This made prices for things like houses go way up, which folks looking for good returns started investing in real estate because it was one of the few ways to make money with such low rates. This lasted from October 2011 to April 2022, when the average mortgage rate was below 5%, most of the time now below 4%. These low rates really shook up the housing market, and we still feel their effects in real estate today. At first, low interest rates seemed like a good chance for regular folks to buy homes, but rich investors saw it as a golden opportunity. They used a lot of money to buy extra homes, rentals, and Airbnb places. Now, almost 40% of homes in the country aren't lived in by their owners. This shift started in 2007, when interest rates changed a lot. To put it simply, some rich people are treating houses like cash machines, and it's affecting the rest of us. The housing market, once a symbol of stability and dreams, is now showing problems. It's like the cash machine is running out of money, and people worry the whole system could break because of this unchecked greed. It's not just one person's complaint. Many people are genuinely concerned about housing's future. This is a real worry because some say this is the most unaffordable housing market since at least 1983. Owning a home is getting harder for many people, and it makes us wonder if the housing market can last like this. The University of Michigan has been conducting a survey that delves into the home buying conditions dating all the way back to 1960, which gives us access to over 6 decades of data. What's truly eye-opening is that within this extensive dataset, there have been only 2 other instances where participants reported home buying conditions as unfavorable as they do today. Many would argue that, in fact, the conditions today are the worst we've ever witnessed in the history of real estate, and for several compelling reasons, they may be correct. The housing bubble has swelled to unprecedented proportions, but before I delve into the potential triggers for this bubble to burst, I'd like to take a moment to ask for your support. If you're finding this video informative and engaging, kindly consider hitting that like button and subscribe button. Every like fuels the algorithm and greatly aids our channel, and your support is genuinely appreciated. Now, let's go back to our talk. Some might say, look at the deep in the data around 1983. Things might not be as bad now as they were back then, but this comparison has a problem. Yes, in 1983, interest rates went super high up to 18%, but it didn't last long. They quickly dropped to 16%. Also, in 1983, interest rates went down a lot, so people with high rates could get lower ones around 12 to 13%. Back then, this was just a bit high for mortgage rates. Until the late 90s, mortgage rates were hardly ever under 10%. This shows that today's home buyers are facing tougher challenges in a market that seems scarier. When we look at how interest rates change from year to year, we can see that what's happening now is unlike anything in recent history. Over the past 2 years, rates have gone up in a way we've never seen in modern America. It's happening faster and is more severe than what happened in the early 1980s. This unique interest rate jump puts us in unknown territory. We're dealing with something that's never happened before. As rates keep going up, some people think there might be big problems ahead. One idea is that the market might have a big drop, especially in the short-term rental business. This situation is often called the Airbnb crash these days. The main idea is that in many big cities in the United States, lots of people are renting out properties to vacationers. These places are usually owned by investors. You can see this in cities like Miami, Las Vegas, Scottsdale, Orlando, and others. When you look closer, you'll find out that many of these properties were bought with SCR loans. These loans are a bit different and not so safe. They were first made for things like hotels and resorts, but now include Airbnb places. What's special about these loans is that they don't look at how much money a person makes right now. Instead, they focus on how much money they think the place will make in the future. This makes things more complicated and riskier, adding to the uncertainty about the market. Imagine you're buying a property for Airbnb rentals. Some loans focus on expected Airbnb income, not your finances. But there's concern these income predictions are too optimistic, possibly causing issues. Many homes are now short-term rentals, but with high supply and low demand, they might not do well. This could affect the housing market. Some think many of these special Airbnb loans are going bad. When investors sell these properties, it could create a big market problem. In the housing market, there's a Pareto principle. It means a few property sales can change nearby home values a lot. For example, just 4% of sales can affect about 64% of nearby houses' prices. This is why a relatively small number of distressed sales, particularly money-losing Airbnb properties, could undermine inflated property prices. In real estate, it's crucial not to sell too early and risk seeing prices drop further. Once a fire sale starts, it's hard to stop, and with low transaction volume, it wouldn't take many forced sales to cause unprecedented price collapses due to the market's low liquidity. Thanks for watching. If you found this video valuable, please like, subscribe, and share your insights on the local Airbnb market in the comments below. Your input is appreciated.